You're listening to the RE Social Podcast with your hosts, Andrew and Vince from OnV Invest. For more information, go to onvinvest.com.
What's up, guys? Welcome to another episode of RE Social. Today, we have a super special guest. We have Ashley Wilson from Bar Down Investment. Welcome, Ashley.
Thank you so much for having me.
Yeah, so I know about Ashley from actually listening to Bigger Pockets podcast a long time ago. And I know you also partner with Jay Scott nowadays. So for the three people who don't know who you are, can you give a brief intro about yourself?
Yeah, so I'm a full-time real estate investor. I started investing in real estate in 2009 as kind of a side hustle. I worked in clinical R&D for 3 major pharmaceutical companies, and that took up the majority of my time, but I was making very good earning early on in my career. And so is my husband. At the time, he was just my boyfriend, but he introduced me to Bigger Pockets in 2007. So we started listening to the podcast in 2007, read Rich Dad, Poor Dad, drank the Kool-Aid, and realized that real estate investing was a great investment vehicle for what we wanted to achieve in terms of how we wanted to grow our wealth. Obviously, it's a tangible backed asset. It is heavily tax incentivized. And in terms of recession resistance, depending on the asset class, it can be very recession resilient. So there were a lot of different factors. We weren't firm believers of the stock market at the time, and we wanted to deploy our capital elsewhere. That's what landed us in real estate. So over my tenure, I've done everything from house hacking to short-term rentals, long-term rentals, flipping, high-end flipping. And in 2018, I transitioned into commercial real estate. And now I am the founder and CEO of Bar Down Investments, which is an investment firm that I partner with Jay Scott. Originally, my husband and I founded it together, but my husband has stepped down on his heavy involvement in the company. And I asked Jay if he would join as a partner. So Jay and I have partnered now together for about 2 years, a little over 2 years, but full partnership capacity, about 1.5 years. And we're growing our business. Our goal for 2030 is $1 billion assets under management. We're about 100 million today. So I think that it's very achievable of what we want to target for 2030.
You know, we thought we are big dogs and we have 8 under management. So that's funny that you guys, what a great time to read Rich Dad Poor Dad, 2007, huh?
I was just going to ask about that.
Talk about timing the market. Like Ashley, it's like, yep, we found the best time in the history of the United States. So
yeah. How did you guys decide to enter into a completely new, like, investment strategy and vehicle right when everybody's probably, your whole family's telling you run for the hills? What was that experience like?
It was interesting because I have to give 100% credit to my husband. Both of us were making a very good earning. My husband was a professional athlete, so he was making really good money as well. And he is very fiscally responsible. I credit that to his parents and also to his culture. He's Canadian, and Canadians, I tend to find, are more fiscally responsible, and it's all based on how their credit system is operating, formed, or I don't know how to word that, but essentially the US credit system is built off of you having debt and your ability to pay off debt. That's how we establish credit in the United States. The Canadian credit system is built off you not having debt. So your credit is established because you don't have debt. That I think lends itself to be more fiscally responsible. The US has normalized debt. There's definitely a debt normalcy in this country. And I think it's good and bad. It depends on how you're utilizing debt and how you're leveraging debt. But because he has kind of a different mindset when it comes to money and finance and wealth, he started looking into other investment vehicles because everyone was just saying, well, the stock market's the only way you can invest. And that obviously is not true. So that led him down the path of looking at all different asset classes. And he thought real estate was the best suited for him at the time. And then he introduced me to it, figure out, whether or not I agreed, because we're both pretty analytical people. So that's when we both dove into it and then came to the same conclusion that it was very well suited for what we wanted to achieve.
Yeah,
Wow.
that makes. Did you have a follow-up
I just
question?
love this podcast because selfishly, I get to learn so many things. The whole Canadian that blows my mind that their credit system is based on the lack of debt. And in the United States, it's literally the opposite. So then I got to ask the question, there's different kinds of debt. So how does that play into kind of that mentality? Did you guys just buy everything outright up front, or are we financing?
That is a great question. And honestly, it's probably the biggest blind spot. There are two blind spots that I have had over my career in real estate, and that is definitely the first one. The first blind spot I had was not realizing how we could leverage other people's equity or debt. I mean, when you first get started, it's really hard to leverage debt because the way our system is set up, especially with construction loans and commercial loans, it's all kind of based on your track record. So it's kind of like, how do you get an entry-level job with experience, with the prereq that you have to have experience to get an entry-level job. It's hypocritical or counterintuitive, I guess. But ultimately, when we first started, the first purchase we made was a house hack that we turned into a short-term rental and long-term rental. And that was during the time of I don't know if you guys remember, but the Obama administration did a first-time home buyers incentive where they did a tax credit. I think it was $8,000 for your first home. So that was something that we played off of. And that's when 2008 was starting to come about and these houses were going into foreclosure and short sales, and that we were able to capitalize on a home that was in that particular situation and bundle that with the first time home buyers. So we were able to get a mortgage on the property coupled with the tax incentive and get it at a discount. So obviously that property did very well. And it was in a market that had, something like Disney, for example, like Orlando. Orlando market's really hot when the market is really hot because people travel to Disney as a tourist destination. But when you're during a recessionary period, most people don't take as many vacations, and the vacations they do take are typically vacations in which they can travel to by car because it's less expensive to drive somewhere than to fly, a family of 4 or 5, whatever, to a destination. So this led itself really well because it was a tourist destination year round where we purchased this property, and it had different events that pulled tourists year round. So it wasn't the same, like Disney is the same thing all year round, but this location was something that had different events all year round. So there's constantly demand for this property. So that's something that we were able to tap into just, from a traditional bank loan. But then when we got into investing, we utilized our own capital in part because we had capital, but it also limited how we could scale. It limited the price point in which we could purchase. So we never developed and honed in on those raising capital skills. And that obviously came back to kind of haunt me later on when we got into these bigger deals and we wanted to scale because our scaling was capped at the capital we had. And that took some time to develop those skills. We're still developing those skills and building out marketing. And I think we're doing the best job out of our history, but we always could do better. And we're starting at such a deficit. I think having capital is a deficit when you start investing in real estate, which is ironic because most outsiders think you need capital to get started in real estate, but it's honestly the last hurdle. Like you really don't need capital. They're printing money every single day. Capital is not the shortage. Investment opportunities are the finite in the business model. So that's something that was a huge blind spot for us that we only recently, within the past, I would say 4-5 years, have kind of, first of all, realized it and then take efforts to combat the challenges that we've faced.
I see that, great answer, by the way. I wanted to follow up on that. I see that, when people start off, including us, we solve the same way, like capital is scarce we tend to realize it now that it's because of our mindset. Like you talk to people who have no money, and then you talk to your mom and your mom's dog, and they both don't have any money. So now you assume nobody has money, right? So how do you go from that spot to actually meeting people, going to events and saying, wait, there's plenty of money, you just don't have access to it. So how do you change your mindset and how do you get access to that money? Because people have to give you, the feds are printing, but they're not giving it to you. They're going to develop some other bullshit social program, right? And then they're going to give it to that.
Yeah. So in terms of surrounding yourself with the right people, it's all about networking. Everything in life is about networking. So today, more than ever, the ability to touch people that you didn't have access to before is just so easy. I mean, when I got started, there weren't Zoom, Zoom wasn't a company. So the platform in which you hold real estate events was in person. It was at a restaurant. It was at a venue. So you physically had to leave, the confines of your home to go out and meet people. Today, you don't have to do that. I think of COVID as an accelerator event. I think it's an accelerator of businesses that were ultimately going to fail. I think it's an accelerator event of technology. And one of the accelerations we saw in technology was the fact that now you can attend a real estate event sitting in your home on the East Coast when the event is broadcast on the West Coast. That's something that you didn't have access to before. I think that the number one reason real estate can be extremely lucrative is because the funnel of people doing real estate, when you look at it from the top, there's so many people who are doing real estate or quote unquote saying that they do real estate. But the biggest drop off between the top of the funnel and the next tier is follow up. And I would suspect that probably 95% of people don't follow up to the level of follow-up that's required. So what I mean by that is it's not just like one email after you meet someone at a Zoom. It's, 5 emails and consistently over a month or a month and a half period of time. Amanda Holmes, who is the daughter of the gentleman who wrote The Ultimate Sales Machine, and then she has now just issued a new version of The Ultimate Sales Machine. She was saying at an event that I was at that it used to be 7 touches. I think we all know that in marketing, 7 touches. Well, today it's more like 12. And that's just because the number of things that are coming at us. So if you're not following up with people even 7 times, the likelihood of you establishing a relationship and connection with that person to be able to do business with that person is very slim. So I think by exposing yourself, I know exposing yourself to these different situations, always being in the room, that gives you authority too. If someone is serious and they're looking for people to partner with, they're going to go to these events as well. And they're going to look for people that they constantly see engaging and asking questions and providing answers and being an opinion leader in that realm. And if you're just sitting back and you're not taking the action and the efforts needed, you either need to align yourself with someone who is like that. So I'm not trying to say that introverts can't be successful in this industry. They can, but they just need to align themselves with extroverts, and they can do another aspect of the business. Raising capital isn't the only way in which you can be successful in real estate. But if you are going to do that, it's not one call and one email, it's multiple follow-ups that get you further, ahead in terms of finding those partnerships.
Wow. I love all that. There's so much to unpack. And that's something that's kind of in our journey that we're starting to get into now is, partnering and just going higher and higher level, raising more capital. And it's definitely helped that we have like amazing, established guests like yourself. So thank you, by the way. This podcast has really helped us a lot to kind of expose the experience and the deep knowledge, especially that Vince has in all things real estate. But also having our meetups as well has really helped, and getting in that room, becoming the thought leader, building our brand is definitely making things easier. Something that we're working on is the follow-up, like you were saying. It's just, as somebody who comes from a sales background, that's something I still forget. And that's such a great point that you brought up, and I hope the listeners are taking from this. And that's with all things, not just raising capital, not just sales. I think following up is extremely important in everything, whether it's your relationships with your mom or your spouse or business partner, whatever it is. And that's something that Vince and I have definitely been doing a lot more of, which is almost daily phone calls of just like a recap, like where are we at, what are we doing, what's happening, what was the win, what was the loss today. And by the way, as you were just saying that, I just made a little additional task on my list here, creating a MailChimp announcement about our meetup we got one coming up. Man, so much to unpack. Vince, what do you, any comments on all that?
Yeah, I was going to ask you, I'm writing down some stuff as you speak, actually, do you use like a systems? This is one of the problem that I have, like when I go to the meetup, right? I mean, all the big BP con we were at, actually, there is so many high level people. So I can obviously remember you, I got Amanda Hahn, Kat Petke, these guys, I always know top of my head, right? So I can follow with you, but that I also met 50 other investors, and it's kind of hard for me to keep track and follow up and trying to do stuff. So do you use any systems? Is that a software that we should know about? Put it in there and then it just automatically emails them or something?
So I don't use a system in which that I think that's actually a brilliant idea, but then you might even want to reach out to Amanda Holmes about that, because she's all on sales, and I turn to her for, a lot of advice on conversion. One of the things that she talks about is, and I forget what she coined it, but she has like a name for it. And it's something to the effect of like the selfie conversion. I forget what it's called. I'm not even going to try to do it. But basically, when you meet someone, you say, "Oh, can I take a picture with you?" And naturally, they're going to say yes. And then you take a selfie with them. And then you say, "Oh, can I get your number so I can text you the picture?" And everyone's going to say yes. Like she said, she's talked to some heavy hitters, celebrities, et cetera, because she's not just real estate related. She talks all over the world. And, she's talked to some heavy hitters, and they're giving out their cell phone, because they're not going to say no. It's just something like you like naturally say yes. And you're like, "Oh yeah, I probably shouldn't have." But the point is that you give out your cell phone, you've taken a selfie, you've given out your cell phone number, you text the person the picture. So now you have a picture tagged with their phone number. You can add that in your contacts. So now you remember, to your point, because when you do go to conferences, you meet like 50 people. And then you can easily go back in and text them, "Hey, I hope you really enjoyed the conference, whatever. Oh, what's your Instagram handle?" And then you start following the Instagram handle. She said there have been a couple of people she's had a really difficult time like converting. But what she does is she literally stalks their Instagram or any other social media platform, and then constantly makes comments like once a week or whatever. "Oh, I saw that you just went skiing. I actually just got back from skiing," or I did a trip at that location, back in the day. And some people, it's right away, it's automatic because you're relating to them. But other times it takes more time to develop that relationship. But she is really, really good at building relationships, and that's how she does it. So I have kind of taken that method. I only learned about it this summer, but every conference since then, especially if it's someone that I definitely want to stay in touch with, and it's someone who I consider is at a higher level than I'm at, or a level that I aspire to be, I make a point of saying, "Oh, can I take a selfie with you?" And then I start a relationship with them over text message. Just, you never know where it may go, but to have that context is always good.
Wow. That's so simple, but so brilliant.
Ashley, you've probably been out of the game for a little bit, but this is literally what we do to get phone numbers from chicks. Like, this is what we do. They take us off with
Parallels.
we'll text it to them. Yeah, it's
The
too
parallels
real.
of sales and dating are
Dating.
just crazy. I remember I discovered that a while, like by accident. I literally did that because I was just in the moment, and that's totally, it totally works for dating as well as with all that.
Yeah. I'm pretty
That's-
sure when I was dating, they didn't even have picture capabilities on phones. So I had been out of the game for a while.
It's a hack. So I got a quick question. I'm less familiar with your presence than Vince, so I apologize if I'm kind of going over something that maybe you guys have established. Maybe it's great for the listeners, I guess. But how did you? I kind of want to know a couple things, and then let you just kind of go off. So, from what year to what year? Okay, you said 09 to this year. What was like the controlled asset amount to today? And I know that number is going to be insane. So the follow-up question is going to be, how did you scale so fast?
So I'll answer the last question first, which is I didn't scale so fast. I've been doing this since 2009. So, what are we, 13 years in now? It's taken time. There's a reason why the 10,000 hour rule is coined, because it takes 10,000 hours. I think the differentiator between me and maybe someone else is that I have a little bit of self-diagnosed OCD, and I have an issue where if I don't know something like down to the nitty-gritty details, I don't want to be in there. I don't want to play in that arena, but I want to know it. So I get very obsessive about learning every single aspect of something. And then I systematize it, I automate it, I delegate it, and then I'm out. And then I'm on to the next thing. And that has been kind of my career path. So when, kind of put it in perspective, when we first started and we were house hacking and we were doing short-term rentals, I was a lazy investor. I had a W-2. I was young. I liked to party. I wanted to travel. I did not want to be bothered by people making reservations or complaining to me about any issue at this rental. So I literally, this is before tech integration with, Ring, whatever they're called, pads or whatever, for the door and all that kind of jazz. So, I had a lock box at the property for the keys. I had keys hidden around the property that I could use because I wasn't located near this property. I gave neighbors keys. I gave the cleaning company extra sets of keys. I realized that every property in the market, you could check in. The earliest you could check in it was 3, but the earliest you had to check out was 10 a.m. So what I did is I was like, wow, that's like what is that? A 5-hour changeover period. I was like, what if I could shorten that to 2 hours? How do I shorten that to 2 hours? So I paid extra for our cleaning crew to have more staff to be able to clean our site. But not only did I do that, I got 3 sets of everything, 3 sets of linens, everything. So instead of them doing the laundry on site, I paid for them to do the laundry off site because I knew that I could command a higher rent if I had a shorter changeover period. So if someone had to check out, let's say we bumped it to 11, but then someone could check in by 1. Now all of a sudden I have a 2-hour changeover period that gives someone who's checking in, oh my gosh, we could check in by 1. We could spend the morning doing amusement park stuff and then come have lunch, a late lunch at the house, be checked in and go back and, do whatever. Not like we're at 3:00, we're getting settled. Now we have to figure out dinner, whatever. And vice versa. Oh, we get an extra hour to check out in the morning. We only have to, be out of here by 11. That's much more feasible. So that's to start. I know that wasn't your original question, but just kind of showing you in terms of how I started, it was purely out of laziness. Don't call me about a toilet issue. You call this person. Call full issue. It's this person. This general contracting is this. I had all these numbers of what's the problem. This is the person to call because I didn't want a single call. I also gave incentives for people to book a year in advance. If they previously booked the year before, they got a discount if they booked by the end of their stay for 10% off the following year at the current rate. And I raise rates every year. So that was all incentivized because if I could book everyone through the same cycle and I never have to do any marketing, never have to do any advertising, like that helped me as well. It helped me with the headaches. I already knew the guests, it was just very easy for me to set it up that way. So that's kind of how it started. It was just, I was lazy and didn't want to deal with all this stuff. I wasn't lazy. I was just my bandwidth. I didn't have a bandwidth to deal with these rentals. So that was the start. And then from there, I left pharma. And in 2014, I was living in Europe, but I started a high-end flipping business with my dad back in Pennsylvania. So my dad's a general contractor. He's had his own business for over 40 years. So he served as boots on the ground. I found the properties. I ran the numbers. I did all the design. I ordered all the materials. I scheduled all the contractors. He did the permitting. He got the guys on the site. He managed the work, but essentially, like, I did everything that you could do remote. And we built that business pretty successfully because most people, once again, it was niche-y, right? You find the void in the market. The void in the market is most people who flip homes can only flip homes max around 300,000 price point, because that's all the money they have to put down on the home. They want cupcake flips. They don't want full gut rehabs, and they don't want historic homes. Well, we did the complete opposite. We did high-end homes. Typical acquisition price was around 500,000 or 600,000, and then resale $1 million plus. We did historic homes, not historic on the historic registry, but historic because we live in Pennsylvania. Most homes are built in the late 1800s, early 1900s. So we would target anything from like 1890 to 1960 was the majority of our homes. And then we did full gut rehabs. Most people don't want to do full gut rehabs because they don't know how to do it quickly and they're susceptible to market changes. So the first full gut we did took us 9.5 months. And I had my dad teach me every single part of the process. And then I got it down to 9.5 weeks on our very next one, which had actually a bigger scope. So, and it's all about understanding every single aspect. That's what I was saying. Like, I get OCD on knowing every single detail and figure out how to make it run more smoothly. So we got that down to 9.5 weeks. Well, now we don't have that market exposure in terms of shifts in the market. The predictability of the market, you can predict out typically, I mean, COVID's an anomaly, but you can predict out typically market shifts a quarter out or 2 quarters out. You don't normally see drastic changes within that period of time. So we were able to do that. And then in 2018 is when I came back like 2017 from Europe and Russia. And then I knew that we wanted to get into commercial. So I broadcast it to the world. I said, this is what I want to do. And this is the value that I add. The value that I add is that I'm very good with operations and I'm very good with construction. So it just so happened that there was a person that I told that had 124 unit under contract. And while they were under contract, one of the buildings burnt to the ground and none of the partners had any construction experience. They had no idea what they were going to do. And the seller didn't want to rebuild the building prior to close. They wanted the buyers to take on that responsibility. So they asked me if I would come on, do asset and construction management of that property. So I started doing that. And I realized that there's a huge void in the market in multifamily of people who, first of all, operate properties because they rely on cap rate compression to take them out, which now we're seeing cap rate expansion. So you're really going to see who wasn't, doing what they should have been doing over the past 3 to 5 years. But then coupled with that is most of these operators, no one on their team actually has any construction experience or knowledge. So they're relying on construction companies and third-party contractors who literally have no alignment because they're compensated based off of a percentage of the total construction costs. So they're not motivated to keep these down or have shorter timelines. And they outsource it. And then cap rate compression has gotten them these incredible deals on the sales side, but yet they've underperformed in operations. So I marketed myself as someone who could partner and get properties reperforming. And over a 6-month period of time, I was sent about 70 properties. There were a few that I consulted on. And out of those 70, I only partnered on one because everything else, in my opinion, was too aggressive on underwriting. And at the end of the day, it's not the underwriter who has the reputation of the property's performance. It's the asset and construction manager. That's where the reputation is tied. And my reputation is way too important to take acquisition fees and call it a day. I would rather, be known as someone who knows what they're doing. So I passed on all of that. And my husband and I had a whole conversation. We were like, we should just do this ourselves. Why are we relying on other people? Because clearly they don't know what they're doing. Let's start doing it. So it's taken a long time because in single family, it was really easy. It's really easy to find the void in a single market and be like, okay, we're going to exploit that. We're going to do all of those things. In single family, my conversion was 7-1. Every 7 offers, I'm getting at least one property. In multifamily, well, the first year was 200-1. And now it's like 450-1. So, in terms of like, I have my metrics behind me, I'm sure it's hard to see there, but like, it's very difficult in multifamily to acquire because you're competing against a lot of people who don't know what they're doing. So they're overpaying for the property. So that in turn creates inflated evaluations of what these, because really in multifamily, you're buying businesses. You're not buying real estate. You're buying businesses, real estate's attached to it. So to me, there are a lot of properties that have transacted with an inflated evaluation because people don't truly understand operations, and the cap rate compression has carried them out of the deal, carried them through exit. But now we're in a situation where that is the reverse. Previously we had cap rates, like you're making on the spread, right? You're making on the spread between the cap rate and the interest rate. Well, now what do you do when, the interest rate's higher than the cap rate? Like that's an issue. So it's an inverted relationship. So it really, really comes down to how you're operating properties. And I think that is a void, but it's a void post-acquisition. It's not a void pre-acquisition. So kind of a long answer there. And to your point on the monetary, I know you asked for monetary numbers. With respect for the single family, I wasn't holding anything. I was holding stuff at the beginning, and we held the stuff, I guess, throughout a little bit of the flipping. But flipping is just, it's like turn and burn, right? You're just buying these properties, and we would do anywhere from 4 to 5 at a time of these higher end properties. With multifamily, we're at 100 million AUM, but we've also sold properties as well. So, and that's the other thing too. Everyone likes to give these statistics on AUM or unit count. I'm a firm believer that unit count means nothing in terms of someone's ability to execute. And also AUM doesn't either, but AUM just seems to be a metric that a lot of people utilize. But how do you actually evaluate AUM? Are you evaluating on the acquisition? Are you evaluating it on what you believe fair market value is today? Or are you evaluating it on what you're going to sell? So that's another thing that I think people kind of inflate. I've done it off of what we acquire it at. I think that's more conservative, but obviously that goes with the disclaimer that you also believe none of your properties have gone down in value since what you purchased it from. So I just would caution everyone that's listening that when you're hearing all these metrics from different people, they're just metrics. Like they're not an indicator of how good someone is or how not good someone is. I mean, when I first started, I had less than a year's worth of experience. I was talking to all these people with 10 plus years of experience, and they couldn't even understand what I was talking about because they weren't focused on operations. They were just focused on, oh, well, we know this market. And I would go, well, what about operating the business? And then I kind of talked to them about operating the business. They, crickets. They didn't have an answer because they didn't operate. They just continued to acquire. And some people's models, their business model is built that way. It's just, we're a fee-based company. We just want to collect fees. We don't care how investors' investments actually pan out in the end. That's not the way we do business, but that is the way some other companies do. So just, word of caution that if you are looking for investment opportunities, that you understand whether or not the operator is aligned with your interests. Is their capital, their personal capital, invested in the investment as well? So that's something to take into consideration. Exactly.
Yeah. Great point. I actually wanted to, great. My light switched off. Let me wait. I actually wanted to break down some of the concepts you were talking about, because it's even real high level. People are probably like having a panic attack because they probably didn't pick up a lot of the things. So one of the things that you mentioned was that the cap rate and the interest rates, being inverted. So what that means, guys, is if you buy cap rate is short for capitalization rate. So it's, if you bought a property with cash and it's a 5 cap, after all expenses, you're going to get $5 back for the $100 you put in, right? So what Ashley was talking about is, if you're going to get $5 back, but if your interest rate is $6, and if you finance 100% of the property, you're losing $1 just if it is under interest only. Now, if you add principal, then you're still negative because principal goes back in the property, but you don't get cash flow, right? So the only way you could buy this property is you raise more money, or you put down a lot of money, and then you're hoping that either rents go up, or you bought it under, you underwrote it that the rents are 50% of market rents, and then you can increase it. But till that time, you're in negative. Is that accurate, Ashley?
Yeah.
Yeah. So that's super risky. You shouldn't, it's like me buying a single family, and then the PITI is $1,000, but rents are $500. But I'm like, bro, I can increase the rents to $1,200. So we'll be bleeding $500 a month for a long time till you can increase that, right? This is how
It's
people
not sustainable.
Yeah, it's not good. So that was one of the stuff. Then I want to shift gears here. I know you're like, Ashley, you have a book, right? Only Women in the Room. You co-wrote that, right? And then you talk about how, like a lot of us in the industry, they might think they're minorities. They don't have that stuff going for them. But I like the fact that you used it to your advantage. I've talked to a lot of people. They always, you've talked to Amanda Hahn about it, Kathy Fetke, but being a woman in the room you're very minority, right? There's not a lot of people, but also I don't know any women contractor, right? I know you, and then there's one more girl from Atlanta. She's also a big syndicator. You probably know her. She's also in construction too. So how do you tell people that you can actually use it to your advantage? Like when I go to like meetups, I look like the most Indian guy you'll ever meet, right? So then I'm using that to my advantage. I'm painting my nails. I have eyeliner on for like Halloween. Drew and I dressed up as Indians. Like I'm from India. And then he was like the feather Indian, right? It's ridiculous, but it's like you can use it to your advantage. So can you tell the listeners, like if they're feeling like, oh, I can't do this, but you can actually use it to your advantage?
I think being a woman is a huge advantage in this industry because there are very few of us, and that makes me stand out. It makes me memorable. It makes me, what's the word? It's kind of like I'm an underdog. And when I speak to brokers, I'll never forget this one time we went. So I knew this broker for quite some time. And I love this broker. Like personally, I love this broker. He's just a great guy, great person. I feel like I've really gotten to know him over the years. And I brought my team to Houston and we went to his office, and they don't work with him. So they don't know him. So I was just, introducing them to him. And he said, you know what is so memorable about Ashley is there's no other woman in multifamily here that is like constantly like on the grind, like constantly doing it. And frankly, and I don't mean this disrespectfully, Ashley, but you're literally the only woman that I remember. Like you're more memorable than some of the men I meet, because it's just, another white male, like, in a blue suit with brown shoes. And like, he pointed it out and he was like, she's so memorable she's so knowledgeable and she's so good in construction. And every time she talks, it's like kind of surprising because it's unsuspecting. Like you don't expect her to have the knowledge. You don't expect her to be so tapped in. And that's what makes it memorable, because you're so different than everyone else that I meet. And that's what makes it memorable. So you kind of play that to your advantage. You play that to your advantage that, you know, people underestimate you, and then you can like prove, you know, you can prove them wrong in a sense. But I just think that being a woman has proven, like, have I felt outnumbered? 100%. Have I felt that it's ever been in deficit to me to be a woman? In some cases I have, but overall I haven't. So in terms of, you know, like, would someone say that to me if I was a man? There's no way. It happens all the time. People ask me, well, you know, what's going on with your kids? Have you guys ever been asked? First of all, they assume I have kids. And then secondly, like, have you guys ever been asked, like, what's going on with your kids when you're out at a conference or whatever? I have never heard a man been asked on stage, nonetheless, like, how do you balance this with your family? Like, next question, please. That's not why I'm here. That's not what I'm here to talk about. You know what I mean? Like, and no one in the audience is here to learn about how I balance it with my family. They're here to learn about how I operate a multi-million-dollar business. That's what they're here to talk about or listen to. And that's what I'm here to talk about. So, you know, just those things are a little irritating at times, but then you got to take the good with the bad, right? So the good thing is that there are a lot of opportunities I get because, and I know this, and I know it's terrible to say, but I know that sometimes I'm just being asked to talk because I provide diversity. I provide diversity to a lineup that is typically all men. And I provide diversity because I know like maybe 5 women in commercial that are in construction, that are knowledgeable about construction, maybe 5. And then I know definitely less than 100, maybe like 50 women who are in commercial real estate, period. So, you know, in terms of getting those opportunities, I think people are starting to realize that we need to have more diversity at these conferences, at these events. And we need more role models. And I am more than happy to be a role model for other women to look up to and be like, I can do this. And, you know, she's doing it, I can do it. So it really just comes down to knowledge and opportunity. So if you're going to, you know, spend time educating yourself, learning everything, then when an opportunity presents itself, you just execute because you have the knowledge backing you.
Love that. Yeah. That's so concise and precise to, I think, someone's success, or at least the predictability of their success. It's just, you equip yourself with knowledge, and when the opportunity comes up or when you find it, strike. So simple. That's great. Do you feel like, you know, because you were saying how you're very aggressive, you went from 9 months to 9.5 weeks or whatever it was in like a deep rehab, like that's so crazy, a full gut. So that was all based on your knowledge and your deep dive. Do you feel like being a woman fuels that, or is that just you? That's just like who you are. It's like,
I think that's just who I am. I've always been like a little, like anyone who meets me, anyone who works with me is like, I can't keep up with you. You're constantly on. You believe in like 4 hours of sleep is all you need. You can power nap in 15 minutes and be like energized, and you don't drink caffeine. And I don't understand how you can do it. And that's, I am like that. So I can go for about, I would say 3 weeks to 4 weeks without a break, but then I need one day of like, don't talk to me about work. Pretty much don't talk to me. Like I just need a day of like, just complete like silence. But then I'm like back at it. But there's something else I was going to say. And I thought, I was going to say the other thing about that situation, that 9.5 months to 9.5 weeks. So there's a little bit more to that story. So my dad and I partnered together. First house we did, 9.5 months. We get the, cash from the sale. We've made like 66,000 total and we're splitting 50-50. So it's 33,000, right? And my dad's ecstatic. My dad's super pumped. My dad's like, this is the best. We got to keep doing this, blah, blah, blah. He is so pumped. I go, Dad, this is, excuse my French, this is shit. Like, this is terrible. This is horrible. He's like, what are you talking about? We just made $66,000 on our first flip. Do you know how many people don't make? Yeah. So it's not a pre-tax. So it's like 90% of first time flippers, or 95% of first time flippers don't make any money. Of that 5%, 90% make like 5,000. It's like total flippers across. I mean, this statistic was like back in the day, so maybe it's changed, especially on the run up on real estate. I'm sure it's different. But the point is my dad was ecstatic. He saw these statistics. He's like, oh my God, this is insane. And I said, Dad, it just took us 9.5 months to do a renovation from acquisition to close. And from the day we bought it to the day we sold it was almost a year to the day. Can you survive off of $33,000? And he said, no. I said, well, I sure as hell can't either. So it's a failure. It is a failure. And we need to figure out how we can make this better. So that 9.5 week renovation, we bought it. I think it was like September 23rd. We sold it. It was like November 4th or November 5th. Between the 9.5 weeks, we sold it like right away. And we made over $100,000. I said, now, Dad, that's how you do it. And you know what? Everyone can say, oh, well, your dad had all this construction knowledge, blah, 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 whatever. People don't dive into that to understand where the gems are. Number one gem is that my dad, so my age, you can guess my age, right? And you can probably guess my dad's age. You should look for contractors who have all the knowledge, but they physically don't want to do the work anymore. How do you maximize their value? So you partner with someone who's like my dad. Just because he's my dad doesn't mean that I'm the only one who's limited to partner with him. In fact, my dad's partnering with someone else right now. Similar situation. He's my age, my dad's partner, and my dad, has the knowledge and is running the site, but he's not physically doing the work because people my dad's age don't want to physically do the work, but they have all this knowledge. They have all this value. So look for someone like that. That's what you should have taken. I don't mean you guys, but people who listen to the story and they just kind of get into this like, oh, well, she had this, she had that, whatever. I already told you having money was a deficit of mine long-term. So you're going to develop a skill better than I could have developed. So you're already at an advantage by just knowing these two things on how to grow your business so much faster than I grew mine. But the other thing is with the 9.5 weeks, it wasn't my dad who got it done in 9.5 weeks. I mean, he physically got it done in 9.5 weeks, but the person who was driving the 9.5 weeks was someone who didn't work in construction. I didn't have a business for 40 years in construction before going on this. I learned every single detail on that first job. I worked with my dad hand in hand on that first job to learn every single process, every single order of operation. And then I said to myself, okay, how do I systematize this? How do I speed this up? How do I have different projects work in parallel? And my dad's like, you can't do that. You can't. I go, Dad, there's got to be a way. There always is a way. There's got to be a way. We got to figure out a way. This is how we're going to make money. This is how we're going to be successful. And we figured out a way. And I said, I think this can overlap with this. I think you do this. And now he runs sites like that. He runs jobs like that. He knows that he can be, because he never looked at it that way, because he had the construction knowledge. He didn't have the investor knowledge, but I had the investor knowledge. So, there's a lot of ways that you can partner with other people that you have different skills that you bring to the table, but can overall make a business very successful.
Wow. Yeah. I love that. I know we have to go. I just wanted to say real quick and ask the last question. I really like what I like about your story, Ashley, is like, you could have made so many excuses and be like, I'm a girl, I'm blonde, whatever. Like I'm not in construction. My dad's got the thing, but you didn't. And you used it to your advantage, which is it doesn't matter what you have or you don't have. It's always the drive, right? You probably, you just have so much drive. Like I can relate to that because, I come from India. My family is not poor, but they're not rich. They just, have something, but the drive I have will beat anybody I meet, right? Because I'm always like trying to do the same thing that you're trying to do. So that's what I really like. I hope people take away that. My last question is, I know we have to go, is the current market condition. What's happening? Like for Drew and I, we are still buying, right? So because we've been in the game for 4.5 years, so we kind of understand a little bit. But how do you tell someone who's looking at it for the first time investment, you're like, no, catch the falling knife is actually really good. You're like, I know it's going to be lower next month, guaranteed, but buy it now. Like, how can you, tell people that, and how do they get in?
I think, first of all, if you don't feel comfortable, there's two ways to get into real estate. I should back up. There's two ways to get into real estate. One is through active investing, and one is through passive investing. And if you're going to get into active investing, then obviously you're going to get into active investing. Obviously, you have to be extremely knowledgeable about real estate. If you're going to get into passive investing, you can align yourself with people who are very knowledgeable about real estate. Just like if you're going into the stock market and you want to invest in Apple, that doesn't mean that you're tech savvy or you're product savvy with phones and computers and iPads, right? So it's not a prerequisite if you're going to do it passively. On the active side, what I would say too is that the great thing about all the different real estate asset classes is when you get more into the commercial field, you can align yourself with people who are more knowledgeable at other aspects of it. So let's say, for example, you're really good like with legal or marketing or accounting, you can do that, and then they can handle the real estate. So, that's something that you can tap into. Yeah. And then in terms of the actual market, like what I'm seeing today, the market has obviously different cycles. And then within each asset class, there are different cycles. And then within each location, there are different cycles. So some people invest with the market by timing the market. Other people invest by knowing where the market's at and then putting reserves in place to be able to weather the storm. So if you're in a situation where your market is in a recessionary period, what real estate, if we look at it historically over the long term, real estate has historically done well. Short term, you can take different snapshots along the way and say that it hasn't, but over the long term, it has. So just be very knowledgeable about where we are in the market cycle and then plan accordingly. Or if you don't want to invest on a downturn, then, just watch the market so you can invest by timing the market, which I know a lot of people do. It's harder to do though, obviously.
Yeah, it is much harder to do. Predict the top and the bottom is very difficult. I mean, think about the last time we thought we were going to have a great downturn, right? When COVID hit. And that was the biggest upturn in the history of like my investing career, 50% in 2 years, right? So people who waited for that, they lost out on the biggest gains. But I know, Ashley, you have to go. Thank you so much.
Thank you.
People get a hold of you?
Yes, you can reach me at Badash Investor on Instagram. You can also go to our website, bardowninvestments.com. If you want to invest actively, you can join Apartment Addicts at apartmentaddicts.com, where we have a coaching program. Both Jay Scott and I lead that program.
Thank you so much, Ashley. Thanks for coming on.
Thank you so much. Thank you. Have a great day.
Yeah, you too. Bye.
Man, so many cool lessons from that. I'm going to be making some Instagram posts, I think, just to kind of, maybe drip these slowly and tease you guys. But here it is all at once, as a nice reward for everyone sticking around to the end of this podcast. So based on just some of the scribbled notes that I've got here on my desk, I love that lesson number one that I got from her early in the conversation was investment opportunity is number one. Capital is not even important at all. If they have a deal, you can be involved. There's so many people I've met who, I don't have money, I have nothing saved. But if you can bring some other value, such as the deal, such as the knowledge, you can be a real estate investor. Would you agree, Vince?
Yeah. So here's how I see it, right? So
Mhm.
capital is not a requirement, but it is a mode of giving value to someone.
Sure.
Right. So
Yeah.
if you say, hey, I look great, I want to help you with real estate. Okay, can you be on our poster or something? Like, what's the value you bring, right? So capital is one, but it doesn't have to be
Right. It's
all.
just one of the value. It's one of the chips you can bring to the table. Second
Mhm.
one was, it's interesting how she kind of, comment. I just kind of want to buzz through this one quickly, but COVID. I love that she just went right through this and moved on, but it ties into a theme I noticed with her as a person. So she said COVID was an accelerator event. That's already kind of in a way rubbing out or polishing out like all the negatives that came with, just the word COVID is already a very negative connotation. You're already polishing it now. And then she said it sped things up. It sped things up in businesses going out that were just like weak and needed to go anyway. Investors who probably weren't running their numbers right, they went out of business. And then sped up the accessibility of connecting. How you're at work right now and I'm at work, and I don't even know where she's from. She's over in her side of the country, and it's so cool that it's granted us that accessibility. This is something that has really helped all aspects of our career as real estate investors, especially with, I should say, tech has been huge in running these short-term rentals that we've been doing. Tech has made things so automated. And so, I wake up to like, oh, I sent 10 messages to answer all these questions, and I didn't send a single one. That was me setting up and systematizing the app. So I love that she's taking one of the big blights in the entire world, that is COVID. And she's like, well, here's how I made it work. Here was the positive. She just kind of ran through it, really quickly. But she even did that whenever she's talking about the woman disadvantage, advantage thing. There was almost like no negatives. She's like, oh yeah, it's a little annoying. Like that was the negative. She's like, oh yeah, people ask me about kids. Like, it's like, all right, which is awesome.
I don't even know if she had kids. I have no.
I know. I still don't know. Right?
Yeah, I don't care.
I don't even care. She's a badass. Take care of the home. But like,
that's her Instagram handle, Bad Ash.
Yeah, I just added her actually. I'm gonna totally tag her up. But yeah, I just love that she just kind of like, oh yeah, no, like I flipped all that to an advantage. It differentiates me. It gets me more speaking positions. People underestimate me, and then I talk for 5 minutes and I realize, oh, I love that. So I love that that's an outlook lesson for everybody listening. Just like anything that happens to you, you can flip it. Whatever your situation is, flip it, and use it to your advantage. What you can't fix, feature. All right. So the third one, I'm kind of try to run through these quickly. I'm sure you got to get back to it. So do I. But I love that she just said, here's a quick one, real quick, guys. Follow up is what separates the top 5% from the rest of the 95. I love that. That's something that Vince and I are working on more and more, and trying to grow our portfolios. We're trying to partner with more friends, more family. And so we're trying to expose them more and get these meetups going so that they can kind of get it. And we're also working on some things on the side to help with that as well. So I love that. Follow up is something that is huge for any business owner. And it's something people just don't do. I think everyone knows it. You and I know it. Like that's where the secret sauce is just following up. But we just forget, or we get lazy, or
Yeah, think about like if I didn't follow up with her.
Exactly. So yeah, and that's totally that's a great point. That's how we're able to interview these like top players in this sphere, the top. You're just like, I just texted them, I emailed them, I met them once.
I'm begging them on the emails, but the listeners don't have to know that.
By any means necessary.
Yeah.
The next thing I got was invest in what you know. She ran through that quickly. My fourth lesson was invest in what you know. And I think that's important. And that's something that she took to the nth degree, and that she would educate herself to where she knew every nuance. And that's exactly what you did early on when we started purchasing our first real estate. You were like voraciously eating. For every book I read, you read 10. And I think that's really helped us to just accelerate, even though we're small players compared to a lot of these people we're interviewing. I think it's still in our immediate sphere, especially, it's insane, so invest in what you know. 5, almost done here, you guys. She found ways to differentiate herself. through checkout and check-in times was one of them. It's their short-term rental game. I love that. That's so great. I get that so often as an operator. Oh, can I check in early? I get that probably 1 in maybe 7 or 8 guests that we have ask for early check-in. Like, it's a lot. Anyways, and then she finds the void in the market. Even as a flipper, she was looking for ways to like get into high-end homes, things that people weren't doing. She basically finding ways to differentiate yourself is always a good business move. Find the holes in the market. I love that. Did you want to comment on that at all?
The different ways to add value.
Just differentiating yourself in some way to add value, exactly, to a market, to a system.
One of the things that since I follow her too, one of the things that she does really well is going after problems, right? So for example, like King Street that we bought, right? It was a problem property and you needed about 180,000 cash to buy that property, right? So we're going after the problem with a very specific set of solutions and stuff like that. So she goes after like really bad rehabs, the high-end flips. Those are problems. Brandon Turner goes after mobile home parks, which are half empty. Nobody wants that. You can't even get a loan on it. But he can raise probably 10 million in a post in Instagram, right? So he can go after that property. So, going after problems that you could provide solutions to.
Wow. I love that. That's awesome. That's a huge lesson. And then lastly, just knowledge and opportunity. It's so simple and so concise. I think that's probably my favorite, because when you really know something well, you can simplify it and say it in a couple words. And that is a case in point. When she was just like, oh yeah, just knowledge and opportunity. Like that's really it as business owners, if you want to become successful in anything, whether it's real estate or stocks or whatever your wealth building vehicle is, it just comes down to that.
Yeah, maybe Brian can make this into like a little reel. Is people always ask us, the risk of investing, right? What will happen if you invest? First question, right? I might lose everything. Here's what I always like to tell them. I know it sounds like a douchebag move, but the risk of not investing or like the risk of losing everything is what you are already today. Like your worst case scenario of your future is who you are today. That is that you cannot get worse than that. Like you are worried about a future where you will become you today. So I'm like, okay, so if you take that as your position, there is no way you can get worse than that, because the worst case, it's like people are like, oh my God, what if I buy a house with you guys and then I lose the home? Do you have a home now? You don't have a home now. Okay, lose the home, sell it for $10. You just made $10, right? Yeah. So that's like a mind, thing. Like you can be like, oh wow, okay, well now if you have 50 homes and then you have a risky like a hotel flip you're trying to do for $50 million, now you're stupid. Now you got to play it, right? You have nothing to lose. Like play the game, bro. Like because you can win and lose, but if you don't play, what happens? You will never win.
Man,
boom, sound bites.
That's a sound bite if I ever heard one, man.
I bet I get 20,000 hits on that. More than Kathy Fecky.
Yeah, tag her up, man. Tag her up. And then lastly, I just wanted to plug her book. What was the title of her book one more time? I didn't quite catch it.
It's called The Only Women in the Room.
The Only Woman in the Room. That's cool. Love it.
Cool book. A lot of ladies, smart ones. They all have their stories in there, and I mean, it's a different perspective.
It's women or woman?
Singular.
Okay, it's only woman in there. Love it.
Yeah.
All right, guys. Well, check out that book. Follow her on Instagram. Watch her content. I know I literally just added her just now. I'll be doing the same. And thanks for listening, you guys. Really appreciate you guys sticking around to the end for the recap. I think we'll probably start doing this a little bit more. Just taking notes has like leveled my game up so much already. So
yeah, man. And I take notes too. Like I have a notebook.
There you go.